We've been waiting for this moment and it just happened. The yield curve has inverted. The market just wet itself. Why? Because this is the trader's favorite indicator for a potential recession. No need to worry because the Fed has your back, right? I mean, they wouldn't let the market crash, right? Yes, it did happen 10 years ago, but this time is different, right? Sadly, many ignore reality and will be punished as a result. You came here for the truth, so let me unveil that for you. Today, we're going to look at what has happened with the yield curve. I want to talk about the stock markets. I'm going to show you the details that you need to know in as quick and concise a manner as I possibly can. Let's begin by taking a look at the markets themselves. I'm recording this video in the middle of the day on Tuesday's trading session, and you can see that the Dow Jones is down 534 points, basically erasing all of the gains from the previous session. The Nasdaq and the S&P are both down over 2% at the time of this recording. You could see that this has been the case where after the G20 meetings, there was nothing but positivity, and there was the suggestion that we would have new all-time highs this year. The market would rocket so fast and there would be nothing in its way, no obstacles in between here and 100,000 on the Dow Jones, 50,000 on the Dow Jones, 40,000 on the Dow Jones. I'm seeing all kinds of predictions being made. Now, I'm not saying one way or the other, but just because of what you saw at the G20, thinking that that's going to be the reason, the catalyst to catapult this further up and higher into new territory is complete hogwash. It's complete lunacy, and it is unfortunately not going to bring it to new highs. You need to have some fundamental changes, or you need to have quantitative easing. There's no other way to put it. Looking further into this, you could see the article, Dow dropped 600 points on fears of slowing economic growth. Banks lead the decline. So no longer is it about the trade situation, because that's put to a halt. We know what's going to happen with that at this point for the next 90 days. We know that there isn't going to be any escalation supposedly. We know everything is all quiet now. However, this apparently slowing economic growth is the big issue. So yesterday it was different. Today it's something else. What's the story? Can we at least get it straight? Can we at least come to a consensus in the mainstream media about their garbage that they spit on us with? And look at this. Well, anyway, they're not talking about the real issue and what has presented itself right now, and it's right here in this Bloomberg article. The US yield curve just inverted. That's huge. The move ushers in fresh questions about the Fed and the economy. So if you want to read the article, you can. I'm going to cover a few articles first, then I have some charts to show you. So let's try to get into this right away. The thing the bond market most feared is starting to happen. Traders have been fretting about the flattening of the yield curve, which is when interest rates on longer duration treasury notes, like 10 years, get closer and closer to the short-term interest rates, like 2 years. And that, fundamentally, if you had a normal market, that wouldn't make sense. You wouldn't have something longer dated be worth more than something short dated. That's the whole point, that you would invest in that longer dated notes. But this is the way it is. The Federal Reserve has destroyed the entire market, and this is what we get. And it happens over and over again. This happens to be an indicator, a very, very good indicator at that. The real fear is that a, quote, flattening curve could lead to an inversion where the longer duration yield actually sinks below the shorter duration yield, because that signals a recession. That inversion occurred Monday between the 3 and the 5-year notes and the 2-year and 5-year notes. And traders think that means the widely watched 2-year to 10-year will soon invert. And it's almost there. I'll show you the chart in just a second. But not everyone agrees it's a dire sign for the economy. Normally, I think that the bond market people are geniuses, but not today. Does it really think there's a recession coming? I don't think so. All right. So of course, this is the way that they are. They have a lot of investments in this. I'm sure that this individual here has a lot of money riding on this, and they don't want their people running off. They don't want all that money fleeing that which they are managing. Of course not. The bond market sees storm clouds on the horizon, despite the trade issues coming to a near-term, let's just say, conclusion. But of course, course, on the longer way to look at things, they really didn't do anything. All right, so the details are there in the percentages. And looking at this one, Double Line CEO believes that the recent inversion of the U.S. Treasury yield curve is a signal that the economy is set to weaken. The so-called bond king told Reuters that the phenomenon is predicting that the economy is poised to weaken. Absolutely, this is the way it is, and it's not because of the yield curve inversion. That's not the reason it is, but that's a telltale sign. That gives us a very, very clear warning, a red flag being flown to tell us that yes, in fact, what you've been looking at is happening at this time. That's all it does. And here you can see the 2-year and the 5-year, which is the red line, and the 3-year, 5-year, looking at this on the yellow line as well. So you'll see that the 2-year and the 10-year, if I can get my highlighter out here for a moment, you can see that we are currently sitting at 13. It's basically all the way inverted for the most part. And it won't happen overnight, that's for sure. Look how long it took. It took a few months, in fact, to get down to this territory from, let's say, back a few months ago where it was and to where it is today. It didn't move that much. So let's say from 25 or so down to 13. So to half that position, it looks like it took, up to 4 or 5 months. So it's going to take a little while. I mean, there's no telling what will happen in December after the Fed meeting. There's no telling what's going to happen in the first half of next year. This is all up in the air, but it just shows us that yes, in fact, the yield curve is inverting. This is definitely a warning indicator for the strategists, for the analysts and the traders and so on. U.S. Treasury, the 3-year, 5-year spread, you could see it moving below there. That's that. Looking at it on a longer term scale, the last time we saw this, of course, was the financial crisis, but don't worry because this time is different. The Fed is not going to let it crash. The sky is falling. Anything else? Chicken Little. Treasury yield curve inversion, and you could see that there, the 3-year and the 5-year crossing over right now. It happened on December 3rd, to be very clear. This shows us the 2 and the 10. You'll see that just in comparison with the GDP. The GDP is the blue line, so you want to look at the orange line for that, and that's the 10-year and the 2-year just falling over the past few years, and that shouldn't be a surprise to anybody. We can see what has occurred in the previous instance in the recession. It's the same situation. Nobody is expecting it. Nobody's predicting it. Only those who are actually opening their eyes and paying attention. This right here is a change of gears, looking at the different currencies and how they performed around the G20 meeting. You'll look at whether it's the yuan, whether it's the South African currencies, whether we're looking at any of these. In fact, look at all of them. The Canadian dollar, the Australian dollar, there's all of these on the right-hand side since Friday. So you could see the comparison of the red, that's since Friday, and then the gray is Monday to Friday of last week. Some of them have completely done a 180 as a result of the whole G20 meeting. They think everything is going to be fine and so on, but it's all really silly to try and chase this information. It's just the way it is. Now, I like to show you this every month if possible, and that is the total return performance of major global financial assets in November. The top is local currency, the bottom is US dollar, and it might be a small font for you, but just wanted to show you that, for example, right now in positive territory, the Hang Seng and the copper and emerging market equities have all find themselves in positive territory for November. You have to remember that because this here has been absolutely beaten throughout 2018, and the change has been to seek out new investments to get out of that other strategy that they were going with previously. All right, so that's that. Obviously, oil is doing terribly, whether we're looking at the WTI or the Brent. That's on the right hand side of those charts. And then the year-to-date performance, you'll see how different it really is. Okay, so the S&P 500 at the bottom in dollar terms is the second one on the list. Looks like about 5% based on that. The NASDAQ NASDAQ up a little bit higher, maybe 7% there. And it's a big change when you look at what has happened over October and November versus the year as a whole. At the very right-hand side on the bottom in US dollar terms, you're looking at the Chinese stock market, Greek stock market, and so on, European as well. Those European markets are not doing good this year. And basically nothing has done well in 2018. In fact, 90% of assets have shown to have a negative return this year. All right, so that's very, very serious. And now to finish off from a quote from one of my heroes, Ben Bernanke, he said this: the Federal Reserve will not monetize the debt. And that just happened to be on June 3rd of 2009, right before they began to monetize the debt. So I have to ask you, for those who believe that the Federal Reserve will do this or that, how do you come to that conclusion? Is it based on something they said? Is it based on the actions that they've taken? Or is that something that you have created in your own mind? They lie to you because they think you're stupid. They think you're stupid and they get away with everything. Just before monetizing the debt, they come out and say the Federal Reserve will not monetize the debt. And they made everyone look very, very stupid. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. Last but not least, if you want the financial education you were not taught in school, these two books have everything you need to know: the foundation, the history, the asset classes, making money, tax incentives, and so on. Check them out at the link in the description. You can always go over to the website, themoneygps.com. I have a trailer for each of these books on there if you want more detail on it. Of course, you can get the audiobook at themoneygps.com as well. Take care. If you're still here, I just wanted to clarify the video that I did previous to this one. I purposely used the image of Chicken Little. He's saying the sky is falling. I have the title saying the stock market will crash with little emoji icons and made it in all capital letters. I purposely wanted people to comment that I knew didn't watch the video, because if they watched it, they wouldn't have made these comments. And there was so many of them. Obviously, there were so many positive notes in there, and thank you all for that. But the individuals who I know don't watch the video, they just go in and leave negative comments. It's kind of sick behavior. It's kind of strange when I see that. I know there are a lot of people with challenges that they're facing, of course. And it's not for me to judge anybody. It's just really disheartening to see a lot of negativity on the work that you're providing, and it makes you sort of take away from all of the information that you're trying to get to as a creator. Okay, so that's what all I'm trying to bring to you basically. What I do, if you're still here, I'm sure that you know what I do, but let me just say it anyway. I take information that I gather over the day, I put it together in a video that I make for people to watch. Now, it's pretty obvious what I'm doing here, but I think people, they take the image that I show at the beginning and the title, and they make that who I am. And that's why I purposely did that on the last video. If you stayed up until the end, you get the whole package, you understand about what I'm trying to do on that one in particular. I've made it very clear, and I think that, you know, my long-standing subscribers know what's going on, and I just want to thank you all for sticking with me throughout this time. I really do appreciate it. I just wanted to say that you can see who has really, unfortunately, they've been facing some difficulty in their own lives, and it's been made very clear. You can see in the comments section how they deal with their emotions, and it's quite sad. It's quite sad the way people are, unfortunately. But I'll still obviously just do what I've been doing, and hopefully people will come around in time. Probably too late for most people anyway, but still got to do what I have to do. Thank you.